as we come to the end of the summer, there's a tragic moment happening in the downstream, midstream industry of the British energy industry. We have to report that another facility has closed down in the Lindsay Oil Refinery. This has been developing over the summer. FTI were unable to find a buyer. So this week, we're going to look at what are the consequences of Lindsay Oil Refinery closing. We then look at what we specialise in, and I sort of do day to day, in that we buy, sell and help operate as a special advisor for people, facilities in the downstream. And we look at, can smaller refineries work in 2025? And then finally, we're going to look at how a couple that appeared in the Sunday Times Rich List in 2023, worth over 1.5 billion, now have a business empire that is in the hands of liquidation, and essentially there is no turning back. How did that happen, and how did we not notice signs? Enjoy and listen to the episode this week. So I was taught in my very early starts of leadership roles in the energy industry, the classic formula that volume is vanity, margin is sanity, and cash is king. What you'll see in this story of refineries is that cash and generating cash is actually become more difficult than ever, and that the volumes, and they might give great huge numbers and turnovers, don't actually underpin any sensible financial case of building a business. And we're going to look at that. The first thing, though, is we're going to look at the consequences. And I think why I've been waiting a few weeks and months to do this episode is that actually a huge amount of friends, colleagues and people I respect in the energy industry have been involved in Prax and the Lindsay Refinery. Before then, most of us in our careers have either sold fuel to Prax, bought fuel from Prax, been to their social events, and they've been a pillar of the British energy community. We've all got good friends that have worked in the industry that are affected by this, from deliveries today because the refinery is closed, to those of our good colleagues that are now searching roles and to deliver roles. And I think you'll see from this, it wasn't the actions of middle or senior management that led to this, but certainly ownership and overinflation of values, and also a difficult climate to run refineries. But let's hear from someone that's worked at the Prax refinery itself, what the consequences are.
We've had 3 weeks to sell the refinery. You know, any homeowner will know you can't sell a house in 3 months, you know, or buy a house in 3 months, let alone a multi-million pound refinery.
So they put it up for sale 3 weeks ago. That was
yeah. So it was owned under Prax until the end of last month, and liquidators have been in and put it up for sale. And after 3 weeks, they've said the bidding is closed. That is it.
Oh dear. And what did you do there, Dave?
I'm an operator on the plant.
So 425 people could lose their jobs here.
Or more than that. So that number figured is purely just Prax employees. There are roughly 1,000 people that go through the turnstiles at that refinery every single day.
Wow. Quite sad to hear that potentially not only the hundreds of jobs that with immediate effect are facing redundancies and loss of work, but also the surrounding areas, surrounding businesses, that the consequence is nearly 5,000 roles. We then go to Ken Cronin, who runs UKIFTA, was a guest of ours on episode 9, and Ken has these words to say recently about the Lindsay Refinery situation. Waking up to the news on Monday the 30th of June about the situation felt frankly like a hammer blow too far. What we urgently require before the winter is a coordinated plan to ensure that product availability for our end users and sufficient supplies on our island to handle weather-related and unplanned operational disruptions. Additionally, the government must consider the triple impact of closure on a number of facilities within a very short period of time frame. And obviously what Ken's referring to there is Lindsay's actually the second refinery that has changed in the last year. Now, the future of Lindsay is more uncertain, but Grangemouth has gone from a refinery to a storage terminal. So essentially, we are looking at, again, a situation where over a period of time, Britain is now down to 4 refineries in the country, with Lindsay Oil Refinery was the 5th largest before closing. And essentially, that's a massive sweeping change from probably north of 20 refineries in the 1970s to even still 9 refineries when I started my fuel career. Now we have to look at the overall economic picture. Can refineries economically still work in 2025? And I have a feeling that sadly, the concept of a small refinery or a smaller refinery probably can't. I've got a list here that if you want to contact me, happy to send over, but shows the impact of a business at the close. And I'm always looking at an environment. Can a business work on its own 2 feet? How do competitors do? And so on. And this is where that although the leadership of and ownership of Prax will come under some scrutiny, you see these examples owned by all sorts of different companies, and you realise the reality difficult of how hard it is to make a refinery work in 2025 in the United Kingdom and in mainland Europe. So we look at this list of stuff that's closed since I started in the fuel career in 2005 that refinery related. So we have got Milford Haven in 2014, that did 108,000 barrels per day. You've got Corriton, which closed in 2012, to 208,000 barrels a day. You've got Dundee's facility closing in 2013. You have got the Maintenanace Eastern Refinery closing in 2010, which was part run by Shell. Then in Romania, you have a facility closing in 2011. In Switzerland, you have Mureș closing in 2015. In France, you have the Petit-Conroy refinery closing in 2012. In Rome, you have a 86,000 barrels per day facility closing in 2012. Then you have some smaller stuff in Italy, a 52,000 barrels per day closing in 2013. And then recently you have Grangemouth that was bigger than Lindsay in terms of its per day figure, in that it was doing about 150,000 versus Lindsay's 113,000. But as you can say, between the two, in terms of actually refinery and production, that's 263,000 barrels per day we've lost. And then you have in Germany, they're looking to closing the Wesseling refinery. And in 2021, Norway had Slagen close. In France, you had the Grand Poitou Total Energies close. And in Portugal, you had the Porto refinery closing in 2021. So you can see a common trend, 2 things. One, city refineries don't seem to have the economic powerhouse, whether it's an independent or major, to survive massive challenges at the moment. The other thing I noticed when you looked at barrels per day, it is clear that running a facility that is under 200,000 barrels per day seems economically unbelievably challenging, because these are all the ones that seem to have closed. But now we look at the other issues that essentially are meaning that refineries are struggling. I would say number one is that relationship of tight margins and mega refineries. And what I mean by tight margins is that when you've got a refinery in a place like the United Kingdom, especially when it's an island format, is that essentially you are bidding for those larger contracts, whether it's aviation contracts or whether it's bus contracts. And when it gets deep into the negotiation stages, because there are storage terminals there that can get product from mega refineries from around the world, the end result is you have unbelievably tight margins that's points of penny. Now, where that's really affected the UK market is that then everything else in the UK market for inflation, whether it's building costs, staff wages, has gone up, but that tight competition hasn't gone away, because you've still got the storage terminals that come in place that take on these facilities. The storage terminals then can get supplied by mega refineries, whether it's the group of refineries out in Pernis near Rotterdam, it's nearly 13 kilometres worth, or you've got those over 400,000 barrels per day international ones such as Gemagar, Rubus and Port Arthur that are producing so much fuel. The next bit of challenge, I think, to UK refineries and European refineries is this ageing assets. Many of them were built 40 to 60 years ago. As a result, the maintenance and the ESG support that you need to get compliant is probably close, they reckon, as an industry average, somewhere between 500 million euros and 1 billion euros. We don't have a full breakdown of what happened at Lindsay in terms of maintenance and management costs, but what we do know is there's been periods of maintenance shut down, and every day you lose, you're losing another, 1/200th of your sales period for the year in terms of high business that you don't get back. And you see that those maintenance issues, not just the cost of doing it, but the opportunity cost of not supplying product, really hit you in terms of what then happens on the refinery sector. The other bits that are pretty challenging, not just my the wind in our outside studio today, but the other bits that are very challenging is carbon taxes and capacity demand. So in the space of from 2009 to 2025, you could say that refineries had overcapacity in 2009. And the reason we say that is that Europe, from all those closures I've mentioned, has lost 2.5 million barrels per day capacity and 15 major refineries. To put that into analysis of the Prax refinery, 2.5 million would be almost the equivalent of north of 20 Prax refineries a day, and therefore you can see the challenge of overcapacity had. And the reason the overcapacity is that many of them were doing retail grades, and as we've seen over the last 5 years, now Europe is selling close to 20% of new vehicles as electric and an even greater percentage as hybrid. That means that one of the main lines of retail fuels has disappeared from the marketplace. The other bit where you've got massive carbon demand is some of the heavier oil products that used to be great margin makers for the industry, such heavy oils to the thing that actually required quite low cost to make, have actually been slowly petered out in favour of better, cleaner products. But essentially, as you can see, is that the EU Green Deal Fit for 55 wants to reduce carbon emissions by 55%, and ultimately refineries specialise in making products that still have a carbon concentration to them. So that again is a major squeeze on them. So you have a situation of you've got ageing assets, expensive to maintain, margins being fought over, and the competition is international, because if you have a storage terminal, if you look at many of those that have closed have turned into storage terminals, such recently as Grangemouth. We don't know yet if that happened at Lindsay, because there's a big debate now that a buyer can't be found where it goes. But essentially, certainly if someone's to bring the Wolfe Power Club in as a special advisor, you'd have to have unique conditions about why a small volume refinery is better than a storage terminal now, when a storage terminal is open to product. Where there's a massive consequence, though, to the government and to society is energy security. Ultimately, with a storage terminal, you are always relying on a longer supply chain and more steps to it, and essentially that supply chain does mean that there's very little fuel that's now being produced in the UK, and we're down to those 4 refineries, having previously been north of 20, and we've seen those consequences. So we go on to the third issue, debt and the destruction of the State Oil Group that owned Prax and that owned many other parts of the company. I think that when I read some of the analysis in the Portland Fuels article, and obviously we had James Spencer, the leader of Portland, come on the podcast on 14th of May in episode 42, and there's a click below if you want to see that, is that essentially I think some of the things James wrote were agreed concerns across the industry about the growth of State Oil and Prax in this period of time. So James writes the following, or the Portland editor that did the article writes the following. It should be noted there's rumours concerning the funding of State Oil have long swirled around the industry, and questions on a small petrol retailer built a 10 billion empire in 20 years never really went away. In fact, one non-executive appointed to the board of State Oil confided in Portland that after 3 years of service, he still didn't understand fully the financial model and ultimately decided to hand in his resignation accordingly. Now, I'd have to agree with James. There was many times where I think there was 2 moments of real surprise about the growth of the Prax company. And I don't actually think it was generously. They was genuinely concerned about where did the money come from, and also how are they going to make it profitable where others have struggled. So one was the acquisition of Harvest. And I think the reason that was a fascinating moment in 2015 is at the time, I think everyone saw Harvest as a much bigger group than Prax, in that Prax was doing wholesale deals, storage terminals, had a few petrol stations. Harvest was a massive growing petrol brand. The next big surprise was 2020, when they did the $167 million acquisition from Total of the Lindsay Oil Refinery. Now, I think then a massive debt question comes, and further surprise. And obviously a lot of this is in hindsight, but there's always times of like, how is a company dealing in parts of the market with very tight margins, getting ever bigger funding and ever bigger growth? And I tell you what, you then look into the detail recently that's come out from the Financial Times and has come out, and the following has come out from the Financial Times. So the Financial Times has said that one of the bits that really has raised alarm bells is that in 2021, the company, after buying the refinery for 167 million, then put into their books that with synergies, its book value is now 667 million. So they put an extra 500 million. And I guess why that rings alarm bells to someone like myself that buys and sells businesses is that whatever value that Prax / State Oil felt they could find, you would never find a buyer that suddenly 1 year later would offer £500 million more. So I genuinely feel there has to be big questions asked about the accountancy and auditing process that allowed this to happen, because essentially anyone in the industry knew the issues about why Total was selling it. High maintenance costs haven't gone anywhere. The other thing that also rings alarm bells about a potential COVID boom and opportunity that State Oil took advantage of is that they suddenly got a loan from HSBC of £783 million in 2021 based on future earnings. Now, what happened in 2021 was obviously it had 9 months of really high and profitable times, and Portland also mentions this about one of the most profitable times of refinery in the last 5 years was that post COVID example. And obviously they've got a massive loan off the back of that to fund the rest of the business. And then the next factors happen in the mid-2020s. So in 2023, suddenly the rich list reports that Sanjeev and Razi, the couple that started Prax Oil, are suddenly the 121st richest family in Britain, worth 1.5 billion. I remember the time the article came out, the Sunday Times, actually messaging a good friend of mine who used to have a very senior role at Prax and say, what on earth? Because you kind of know in the industry, how well people are doing, what their value is. And I think where everyone was shocked is, certainly me, is that you've got ultimately a refinery that's 167 million's worth that has challenges in long-term making profit, in my opinion, at the time. And you have other assets like Harvest that are bought for 22 million. And although they did buy things across the world, including parts of refineries in South Africa, even the administrator now is saying that that collective group of stuff that wasn't the refinery has a value today of about 112 million if they can find a buyer. So essentially you've got two parts of a company worth, about 290 million, and yet the couple's personal wealth was valued at 1.5 billion. Now, the reason that came about was that turnover in a very short period of time had increased to 10 billion from 2.3 billion post the refinery thing. But as we go back to volume is vanity in fuel, and essentially, although there's massive turnovers and things like refineries, compared to other businesses, you can't apply a simple formula because there's also massive cost in making it happen. I think then what was then alarming to people that essentially now we're looking back on about what the cause, and this is probably one of the biggest causes, is interest payments. When the loans started, the interest payments were £19 million a year, which actually, if you've got a service or business and essentially you're looking at like a mortgage perspective, is actually, 19 million, you're looking at under £500,000 a week, and you've got against it potentially a 10 billion turnover. By the end of 2024, the interest payments alone were £133 million. Now, where that blows my mind as someone that works an awful lot in downstream, there's very few businesses in UK downstream that essentially make tens of millions of pounds of profit. To give you an example, the very big distributors in the country may make somewhere between 30 and 50 million pounds profit total year. So if your interest payments are 133 million, it means that in a sector where refineries been closing because they've been loss making, even very, very strong financially run companies like Ineos couldn't make Granger enough work. You're looking at a situation of where you've got £2.5 million worth of interest payments per week. And this I find absolutely staggering, that almost the plug was not pulled sooner at when people do it. What it means is that there is accounts that there's now £75 million worth of loss per year in the business as a result of the plug being pulled on the loan, because apparently there was discrepancies, which doesn't surprise me when you look at the sums of money versus the profit. There's £700,000 of debt owed to Deloitte, who were the consultants and accountants that did Project King to try and streamline the business last year. And then Shell are owed £10 million, I presume, for a product. And in the articles, it's not said what Glencore's owed, but Glencore have been supplying a huge amount of the fuel. And then the biggest one is to the British taxpayer. £250 million is owed to HMRC. And what I wasn't quite sure in the articles whether this was as well as an addition, but another £70 million is owed to HMRC from the other businesses that State Oil owned before it went into this situation of now in the hands of Tenere, trying to look for buyers, selling off assets, and essentially a non-functioning business anymore. So this couple that started their beginnings from Kent University, grew their business in Weybridge. I was always very tempted to join Prax and had several conversations of a senior role because it was a fuel company in Weybridge just down the road from me, and offices in central London, perfect for my location. But I always asked where the money was come from. It looked like it was massively bankrolled by this HSBC loan, but in my opinion it was people in the finance industry giving finance to a set of assets that they based on turnover calculations they might use in other businesses, and not use the detail that we've looked at about why refineries fail. This story is really sad because, as we went to the start, there's nearly 5,000 people whose incomes and livelihoods could be affected by the demise of State Oil and Prax. And I think the big learnings and where we need to go to in the future is that if someone's going from the rich list to company closing overnight, why are loans given out without perhaps more due diligence and using industry experts, such as ourselves and Portland. The other thing I'd like to know is that when the government approached, and apparently both Michael Shanks and Enda Miliband approached Prax between April and May, that more digging wasn't done into the seriousness of this financial situation. And as a result, FTI, who were looking for a buyer when the plug was pulled on State Oil, essentially had 3 to 4 weeks, and at that point concluded they couldn't find a buyer. And the reality of what I've shown, with over 20 refineries closing in Europe, it'd be very difficult for anyone to find a buyer. The Lindsay Oil Refinery story is a sad story. The refining sector is under huge pressure, and you can see that the mega terminals supplying massive tank storage facilities across the globe is the market power that's winning. But we have to ask ourselves, what are the long-term consequences for energy security? I hope you've enjoyed this week's episode, and thank you for your indulgence.